Welcome to Iron Financial. This is the place where we don't just read the headlines, we put them under extreme pressure to help you forge a stronger, more bulletproof portfolio. I'm your lead analyst. Today, Salesforce is in the hot seat. The company just dropped its latest earnings, and they're pitching one heck of a story, a total reinvention around what they call the Agentic Enterprise. Now, our job is to slice right through that narrative, get our hands dirty with the real numbers, and figure out if they are truly building a skyscraper of future-proof innovation, or if there's some deep structural cracks in the foundation that could bring the whole thing crashing down. This isn't just another earnings call recap. This is a full-blown stress test. Let's find out if this company has the steel to belong in your portfolio. All right, let's get into it.
And there it is, straight from the top. That one sentence from CEO Mark Benioff is everything. He wants you to know, in no uncertain terms, that Salesforce isn't just the CRM company you thought it was. He's selling a complete paradigm shift, the Agentic Enterprise. You're looking at the entire bull case, the whole shebang, distilled into one powerful vision. The story they're telling Wall Street is about becoming the essential operating system for business in the age of AI. I mean, think about that. A single, unified platform where your human teams and your AI agents are working hand in glove, sharing data, making decisions. It's a massive, bold pivot. They want to be the central nervous system for every single AI-powered company on the globe. That's the multi-trillion-dollar promise they are asking you, the investor, to buy into right now.
Whoa, hold on a minute there. I'm the market skeptic, and it's my job to pump the brakes. That's a beautiful quote. It sounds like the future. I get it. But is this grand vision being built with reinforced steel and concrete, or is it just marketing mortar? You know, a thin layer of AI hype slathered over a foundation that might be starting to crumble. Are we actually seeing a legitimate, sustainable acceleration in the business, or is this just a fresh coat of AI-branded paint to distract us from the cracks that are showing up in their enormous legacy cloud business? Before anyone gets swept away by the narrative, we need to cut through the vision statement and look at the cold, hard numbers. We have to see if the financial structure can actually support the immense weight of this ambition.
Exactly. And to do that right, we need a clear blueprint for this entire analysis. Here's our game plan. First, we're going to build the bull case. We'll look at the AI growth engine and lay down the steel frame of their argument. Then, our market skeptic is going to take the lead and really stress test the financials, searching for any and every weak point. From there, we'll try to make sense of the very contradictory signals we're getting from the company's own guidance and Wall Street's strange reaction to it. Then, we'll get into the weeds of something really critical, the often confusing divide between GAAP and non-GAAP accounting, to figure out what profit actually means here. And finally, we will assemble the final blueprint and give you our verdict. Let's get to work.
Okay, Act 1. Let's build the steel frame of the bull argument. And you have to start right here, because frankly, the momentum is undeniable. Salesforce is putting up some absolutely staggering numbers in their AI-specific products. And let's be clear, this isn't some fuzzy, far-off, someday revenue. This is real, it's quantifiable, and it is accelerating right now. For the bulls, this is the only thing that matters. They believe this new AI engine is so powerful it's going to lift the entire massive company into a whole new stratosphere of growth. So for a minute, let's just forget everything you know about the old Salesforce and look at the new machine they are trying to forge. Now, this slide right here, this is all about velocity. In the third quarter, the company was very proud to report that its two main AI product suites, Agentforce and Data 360, had hit a combined annual recurring revenue, that's the sticky, predictable revenue they can count on over the next year, of almost $1.4 billion. That's a really strong number, no doubt. But then, fast forward just one quarter. Look at what happened. Agentforce, all by itself, just one of those two product lines, rocketed to an $800 million ARR run rate. Think about that. This isn't just simple growth. This is a story of compounding acceleration. It suggests their key AI product isn't just adding customers at a steady pace, it's hitting escape velocity, picking up serious speed quarter after quarter.
And this chart just visualizes that exact point beautifully. In Q3, that combined AI revenue was up an explosive 114% year over year. For a company of this sheer size, that kind of growth is almost unheard of. But then look what happened just one quarter later. The standalone Agentforce product accelerated even faster, posting a blistering 169% year-over-year growth. Just look at the slope on that chart. It's not just going up, the curve itself is getting steeper. The rate of growth is increasing. This is the exact picture management wants burned into the mind of every investor. It's an AI engine that isn't just firing on all cylinders, it's hitting the afterburners.
So the big question is this just a small niche product getting a lot of hype? And these numbers are here to tell you absolutely not. They've closed over 29,000 deals for Agentforce. That number jumped 50% in a single quarter. That's insane market penetration. And look who's buying. Over 60% of their Q4 AI bookings came from their existing customers. That is the holy grail. It means they're successfully upselling their massive installed base, which is the most efficient and profitable growth you can get. The usage metrics are even crazier. 19 trillion tokens processed. That's the AI actually doing the work, which is up 5 times from a year ago. And 2.4 billion agentic work units delivered. That's their metric for when the AI actually completes a valuable task for a customer. This isn't just talk. This is massive scale execution.
All right, so what's holding all this up? What's the foundation? It's this number, the RPO, a remaining performance obligation. For a subscription business like Salesforce, this might be the single most important number for stability. This $72.4 billion, that represents contractually obligated revenue that customers have promised to pay, but Salesforce just hasn't billed for it yet. It's their total backlog. Think of it like this. These are the massive steel beams that have already been paid for and delivered to the construction site, just waiting to be installed over the next few years. Seeing a number this enormous grow by 14% year over year, it provides incredible visibility and stability. It's a fortress-like pipeline of future business. And finally, we get to the lifeblood of any company, cold hard cash. Salesforce generated $15 billion in operating cash flow for the year. Just let that number sink in for a second. This isn't some accounting trick. This is cash coming through the front door, up a very healthy 15% from last year. This torrential cash flow is the fuel that lets them do everything else. It funds their heavy AI research, it allows them to return cash to shareholders through buybacks and their new dividend, and it gives them a massive war chest for more acquisitions. So that's the bull case right there. A ridiculously fast AI engine built on a fortress of locked-in revenue and fueled by a self-sustaining cash machine. It's a powerful, powerful story. An incredibly powerful story. And that is exactly what it is, a story. So now it's my turn to stress test this beautiful steel frame you've just built. We're going to apply some serious pressure here and see if we can find any cracks in this foundation. Because when you look past the exciting AI headlines and you actually dig into the dense financial filings, the 10K, a very different picture starts to emerge. It's a picture that's a little bit older, a little bit slower, and a whole lot more complicated than the press release would have you believe.
Okay, this slide right here, this is ground zero. This is where that pristine narrative starts to diverge sharply from the messy reality of the numbers. The headline number for Q4 was a strong 12% revenue growth. Looks great on a slide. But was that growth built organically, or was it bought by writing a very large check? Well, deep in the fine print, the company tells us their massive acquisition of Informatica gave that number a big boost. When you do the math and strip out Informatica's contribution, the true organic growth of Salesforce's core business is actually closer to 8.5%. And you see the same exact pattern in their forward guidance. They're guiding for 10 to 11% growth, but then they tell you about 3 points of that is coming from the acquisition. So the underlying business is only projected to grow at around 7 to 8%. Now that's not a disaster for a company this big, but it is a universe away from the hypergrowth story the AI numbers seem to be telling.
Let's break that down with the hard numbers so it's crystal clear. Reported Q4 revenue was $11.2 billion. Of that, $399 million came directly from Informatica. That accounts for about 3.5 full percentage points of that 12% reported growth. The core business just did not grow 12%. It's that simple. And look at the forward-looking metrics too. The current RPO, that backlog we were just praising, grew a healthy 16%, but again, the fine print tells us that 4 points of that growth was just from the acquisition. This raises a really fundamental and frankly uncomfortable question for any investor. Is this new AI engine truly accelerating the entire business? Or is the company being forced to use these big acquisitions to paper over a significant and ongoing slowdown in its massive legacy cloud products?
This brings us to Wall Street, the analysts who are paid millions to dissect these reports. And what we find here is not a clear signal at all. Instead, it's a deeply contradictory and confusing message. It really seems like they're saying one thing in their public ratings, but doing something very different with their price targets and their financial models. And it's in that disconnect where savvy investors can often find an edge.
On the surface, it looks like Wall Street is just pounding the table, telling everyone to buy, buy, buy. I mean, look at this. You've got 27 buy ratings and 1 strong buy, compared to only 1 single sell rating out of the whole group. The official consensus is a moderate buy.
If you just looked at this slide, or if you just flipped on financial television, you would think there is near unanimous conviction that this stock is a screaming buy and headed much higher. It's a wall of perceived bullishness, and it's exactly what the company wants you to see.
But here at Iron Financial, we always tell you, watch what they do, not just what they say. Because in the wake of this earnings report, with its slowing organic growth and messy guidance, we've seen a wave of price target cuts. Jefferies took an axe to their target, slashing it from $375 all the way down to $250. KeyCorp took theirs from $400 down to $300. These are not minor tweaks. These are massive revisions that reflect a substantially lower expectation for the company's future. And look, the market has followed their actions, not their words, with the stock recently hitting a new one-year low. So the question becomes,
Exactly. This is the central mystery we have to solve. What is going on here? Why would an analyst keep a buy rating on a stock while at the same time telling their clients that they now believe that stock is worth a whole lot less than they did just a few weeks ago? If the Agentic Enterprise is the future, if AI growth is really accelerating at 169%, shouldn't those price targets be going up, not down? It suggests that while they might love the long-term story, they see something deeply worrying in the financial statements today. And that something is buried in the great divide between two very different kinds of profit.
Right. To solve this puzzle, we have to put on our green eye shades and become forensic accountants for a minute. Now, this next part is absolutely crucial if you want to understand the true quality of Salesforce's earnings. I'll explain the technical definitions, but the real question, the one our skeptic is rightfully asking, is simple. How much real, actual profit is this company making?
Let's just lay a quick foundation here, because this really matters. GAAP stands for Generally Accepted Accounting Principles. It's the official rulebook. It's mandated by the SEC, and it's the standard everyone has to follow to make sure we can compare apples to apples. Non-GAAP, on the other hand, is a company's own custom, modified version of those results. They take the official GAAP numbers and they add back certain expenses that they argue aren't part of their core operations. Their goal, they say, is to give you a cleaner picture of the business's health. But as always, the devil is in the details of what they choose to add back. And here are those details for Salesforce's guidance. They are projecting an official, by-the-book, GAAP operating margin of 20.9%. That's a very respectable number. But the number they shout from the rooftops, the one you hear on every conference call, is their much higher non-GAAP operating margin of 34.3%. So, how do they bridge that massive gap? Well, they add back 4.1% for amortization and 0.3% for restructuring. But look at that giant yellow slice of the pie, a massive 9.0% for stock-based compensation. They are adding back an amount equal to 9% of their entire revenue. And that is a very, very real expense. It's how they pay their engineers. It's how they incentivize their sales force. And it's a direct cost that dilutes the value of every single share you own. And that's the absolute core of the bear case, right there on the screen. This is not a rounding error. It is not a minor adjustment. Adding back 9% of your revenue in stock-based pay is fundamentally re-engineering your profitability. You're taking a primary ongoing cost of doing business in Silicon Valley, which is paying your talent with equity, and you are telling investors to just ignore it when they look at your main profit number. This is almost certainly what's making those Wall Street analysts so nervous and causing them to slash their price targets. They love the AI story, but they cannot ignore the fact that a huge chunk of that headline non-GAAP profit isn't translating into real, undiluted value for shareholders. It's being paid out to employees instead.
So now we have all the pieces on the table. We've built the bull's imposing steel frame, and we've exposed the bear's potential stress fractures in the foundation. It is time to assemble the final blueprint. Is Salesforce a generational opportunity to get in on the AI revolution at a discount, or is it a value trap for investors who are being dazzled by shiny headlines while ignoring weakening fundamentals?
So let's weigh these forces head-to-head. On the bull side, that AI growth is absolutely explosive. You cannot argue with 169% growth in Agentforce. That is real, and it is happening at a massive scale. And that $72 billion backlog and $15 billion in cash flow, that provides a foundation of stability that very few companies on Earth can match. But on the bear side, the core business is slowing to single digits, and the company is relying heavily on acquisitions to make the growth numbers look good. Those conflicting signals from Wall Street are a major red flag, and that huge gap between real GAAP profit and their manufactured non-GAAP number, it raises serious questions about the quality of these earnings. It's a true battle between a powerful new growth story and the questionable health of the legacy foundation it's being built on. So our final verdict here at Iron Financial is this. Salesforce is an undeniable AI powerhouse, but it's being built on an increasingly complex and, in some critical ways, weakening foundation. This creates a really clear choice for investors.
For those who are true long-term believers in that agentic enterprise vision, who are willing to look past the current slowdown in the accounting games, well, the recent stock weakness could be a significant opportunity to buy a category leader. However, for investors who prioritize strong organic growth and clean, high-quality GAAP earnings, this could be a major trap, where the blinding hype of AI is masking fundamental issues that could stick around for years. Your decision depends entirely on which of those two frameworks you use to forge your portfolio.
And that leaves us with one final, critical question for the future. We're in a market right now where capital is being pulled like a huge gravitational force towards pure-play AI companies, the NVIDIAs and the new, nimble startups. In that environment, can a legacy titan like Salesforce, with its enormous size and slowing core business, truly pivot its massive ship fast enough? Can it innovate at a pace that justifies a premium valuation, or will it ultimately be outmaneuvered by more focused, more agile competitors? That is the multi-hundred-billion-dollar question that's going to define the next chapter for Salesforce. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.